Now we move to Learning Objective 2, how costs are recorded under the expense recognition principle. The expense recognition principle helps businesses determine when to record expenses. It ensures expenses are recorded when resources are consumed or used. This principle is important because it affects profit reporting. Period costs are recorded on the income statement when the expenditure is made. Examples include advertising expenses, marketing costs, and administrative costs. In most cases, these costs are expensed immediately. However, in special cases where the cost is incurred in advance, it may be recorded as a prepaid expense on the balance sheet and expensed later. Be sure to note, period costs are expensed in the period incurred. Product costs are handled differently. Product costs are initially recorded as inventory, which is an asset on the balance sheet. They are not expensed when money is spent. Instead, they are expensed later, when the product is sold. At that point, the product cost becomes cost of goods sold. Please note, product costs are recorded as inventory first and expensed as cost of goods sold when they are sold. This slide provides another automotive example. Steel, tires, direct labor, and factory equipment are costs of products. They are recorded as inventory and expensed when a car is sold. Sales expenses, office rent, and administrative costs are period costs. Those are expensed immediately when incurred. Now we introduce three forms of inventory that manufacturing companies use. Raw material is material in its unaltered state, such as steel for cars. Work in process inventory is material that has been altered, but is not yet a finished product. Finished goods inventory is a fully completed product that is ready for sale. Make sure to write down the three forms of inventory: raw material, work in process, and finished goods. This slide illustrates how a material like stainless steel can move through the inventory categories. At first, stainless steel is raw material. Once it has been partially shaped or worked on, it becomes work in process. Once it becomes a final product ready for sale, it becomes a finished good. Now let's apply the inventory definitions. This question asks, which best describes an inventory item classified as a finished good? Read the choices carefully and identify which one represents a final product ready for sale. Pause here and work through the activity. Once you've finished, check your answers with the solution provided in the back of Chapter 2. Businesses generally try to minimize inventory. Inventory ties up cash that could be used elsewhere. Work in process inventory has no external value because it is incomplete and cannot be sold. Raw material inventory is often the most valuable because it may be returned to suppliers. The key idea is that inventory is costly to hold, and businesses want to be efficient with production and inventory systems. Make sure to note that inventory ties up cash and businesses aim to keep inventory levels low. Now you'll match key terms with their definitions. The terms include raw material inventory, finished goods inventory, expense recognition principle, and work in process inventory. Take a minute to match each term with the correct definition. Pause here and work through the activity. Once you've finished, check your answers with the solutions provided in the back of Chapter 2.